Hello everybody, I'm very excited to welcome you to TD Direct Investing's Learning Center. My name is Phil.
And my name is Sal. In the Learning Center, you have access to a huge variety of educational videos.
Today, we're actually going to take some time to introduce you to an option strategy that some investors use when they expect the market or a stock's price to move sideways. Before going into this strategy, you should have a strong understanding of how calls, puts, basic option spreads like verticals work. If you want to brush up on your knowledge of these topics, check out a webinar or masterclass in the Learning Center.
So, let's jump right in. Hey Phil, how's the market been treating you these days?
I don't know, buddy. The market is not moving much, and I can't seem to make a decent buck with my option trades.
Have you ever tried implementing some neutral strategies, like iron condors?
Iron what now?
Essentially, iron condor is one of many option strategies that may actually take advantage of low volatility and sideways movements in the market.
Interesting. Tell me more.
Let's start off with the payout structure of the strategy. As you can see from the graph, an iron condor profits the most between two price points. Let's call these points the short strikes, the ones that are initially sold. If the stock price moves out of that range, the profit can very quickly disappear. But the good news is that the risk is still limited. The maximum loss occurs if the price moves above or below two other price points. Let's call those the long strikes, the ones that are initially bought.
Wait a minute. This sounds familiar.
What do you mean?
You're talking about long and short strikes. Doesn't that involve some sort of spread strategy?
You're absolutely right. It is, in fact, constructed by combining two vertical option spread strategies. So let's break it down with an example. On the left side, we buy an out-of-the-money put with the lowest strike price of the four options. Then, we sell a higher strike out-of-the-money put that's closer to the current price of the underlying stock.
Sounds to me like a bull put spread, or as someone put it, a credit put spread.
Exactly. If you look at the highlighted line on the graph, it exactly resembles the payout structure of a put credit spread. Now, let's move on to the right side.
Wait, I think I'm starting to get it. On the right side, we are selling an out-of-the-money call with a strike price just above the underlying. At the same time, we are buying an even higher strike price out-of-the-money call to limit our losses on the upside. This would result in a bear call spread or a call credit spread.
You are spot on. And here is the highlighted line. As you can see, it is similar to the payout structure of a call credit spread.
All right, I understand. So the iron condor is just a combination of both a credit put and a credit call spread. What about its max profit and max loss? How are they calculated?
That's a great question. The profit is capped at the net premium received. That's the total net amount received from buying and selling all four options at the same time.
Whoa, let me work through this to make sure I understand. Let's say the total premium received is $9 for selling the closer to the money call and put options, and the total premium paid is $6 for buying the further from the money call and put options. Therefore, my max profit should be $3?
Yes and no. Don't forget that with every contract you sell, you would typically multiply the premium by 100. In this case, you would receive $300 gross of fees. And your risk would be still limited to the difference between the bought and sold call strikes, or the difference between the bought and sold put strikes, less any premium received.
Okay, stop for a second. This is getting a little confusing. Say the differences in my put strikes and my call strikes is $5. You're saying that my max loss would be $500?
You're missing a step. Think back to the premium that you received, which was
$300. Oh, I get it. So my max loss is the $500 difference between the bought and sold strikes, minus my $300 received, which is $200.
correct.
Wow, it is truly amazing what you can create with options. I'm going to go place my first iron condor trade now.
Great. Have fun.
Wait a second. How do I know which options to choose exactly?
Glad you asked. Have you ever heard of the Greeks?
Yeah, you mean Hercules, Zeus, Poseidon?
Funny. No, I'm talking about the options Greeks, such as the deltas, the thetas, etc.
Oh,
Don't worry about it. We'll leave that for another lesson.